good evening, wherever you are. I'm happy to have two people here who I have really wanted to have more discussions with. Maybe this is the plus side of um, the pandemic from the standpoint, at least silver lining, that we actually get to have these kinds of discussions across at least the United States here. With Srinivas Thiruvadanthai and Matt Klein. And I really wanted to have this discussion in light of Matt's book with Michael Pettis, more recent, Trade Wars or Class Wars, specifically to discuss, yes, definitely plug the book, to discuss sort of the adjacency with what our organization, Employ America, is focused on, which is full employment, tight labor markets, with sort of how to make sense of trade imbalances in that context. I think there is some really important points at which these two cross paths. When we think about sort of how to structure macroeconomic policy in ways that are both financially sustainable and are really geared towards maximizing employment and production possibilities. From our organization's perspective, the United States, I think it's equally relevant to sort of the macro policy mix in major foreign economies as well. So I'm going to just sort of give a quick view of sort of where I see those adjacencies, but I'd really be interested to hear from Shri and Matt about where they see those particular points of convergence. I think there are two places that from Matt's book that really stick out to me, where Matt's thesis is really strong, in my opinion, is that there is a sort of odd mix of who generates demand in the global economy and the global trading system versus who benefits in terms of production, right? And who benefits in terms of employment. So what we've seen, especially in the last, call it 30 years, but even longer, you can extend it, is that there's been this real shift towards like the US as the consumer of last resort, the US as an importer of last resort. And that has been a benefit to a lot of developing and emerging market economies that have been able to run either larger fiscal surpluses, larger trade surpluses, because they can rely on the US to be the consumer of last resort, the US to actually run bigger trade deficits. And I think the other side of the coin here is that the US current account deficits, the US trade deficits are largely at their worst when US private sector deficits are particularly elevated, or rather the private sector balances are exceptionally low. And that has usually been coincident to sort of credit booms. So you think about the tech boom of the late 90s, you think about the household credit boom of the late 90s and through to mid 2000s. And the period over the 2010s in which we actually saw pretty healthy private sector saving rates overall was also one where we saw very weak growth overall. So the point when we did not see US consumption and US demand support, not just US employment, but employment more globally, is also the time when we saw the slowest growth. So we really kind of are at a point where we need to think a little bit more differently about how sort of demand gets generated in a way that's actually financially sustainable and can actually lead to long and strong business cycle expansions. And I think there's something to be said for, could we shift to a global trading system in which we weren't so reliant on just the US consumer? And also whether the US macro policy mix isn't so heavily dependent on generating a private sector credit boom to fuel our fortunes and actually get us to something that at least resembles tight labor markets. Those are the two places where I think there hasn't been as much discussion. I have some slides I might pull up at various points if it helps to contextualize what's going on. But I'd be really eager to hear from Matt, sort of that was sort of one part, that's the part of it that really stuck out to me from your book, what you think about that, and whether there are other places of adjacency that are particularly important to emphasize.
So first of all, Skanda, thanks very much for that introduction. And I think that's a really good summary of, I think, what a lot of the big issues are. I mean, just sort of to rephrase it slightly, the way we sort of look at this is that globally, there's sort of a mismatch between productive capacity that is relatively high and relatively underutilized, and as a consequence of consumer spending globally being relatively weak. And, what that should lead to, if you just look at the world as a whole, is some mixture of either slow growth or alternatively sort of high debt among sort of the consuming classes to sort of make up for it. Because, sort of the key part of our narrative is, in the subtitle, it's the rising inequality, that the more and more income is going to people who are essentially not going to be spending on goods and services. And essentially that's what we've seen globally. You've seen a mix of either sort of global growth being fine, but very large increases in debt in certain parts of the world, or global growth being slow in a period when debt is sort of, falling relative or stable relative to global GDP. The trade angle is that essentially, where these things are happening, the increase in inequality, the shortfalls in production, the rise in debt aren't really in the same, they don't have to be in the same place, and they aren't. And so that can lead to large financial imbalances and large trade imbalances. And so from the question of, any individual country policymaker, you're sort of in a dilemma of, well, we can raise our own global domestic demand, which is sort of the main tool we have for boosting our employment and, making sure that our businesses are running and we're not sort of leaving, letting factories lay idle. But, that comes at the cost of rising debt. Or alternatively, if you have a debt constraint, either, perceived or real, depending upon the sort of the nature of the economy you're in, then you can't do that. And then, that's the other sort of downside you're in. And so that sort of creates a dilemma. And I think, in the U.S. context, I think you're absolutely right that the big problems when people talk about the unsustainability of the current account deficit, what at least what they should be talking about, I think what we've seen, particularly in the 90s and the 2000s, is when it was the private sector, both the corporate sector and the household sector, taking on lots of debts and spending much more than they could afford in ways that ultimately were not justified. Whether it was telecoms overbuilding in the 2000s, in the late 90s, early 2000s, or the housing debt bubble, which was financed a lot of consumption. And other countries sometimes it's different stories, but I think that's sort of a general global problem of it's not the current account balances are inherently bad, but um, they're when they work well, it's really in a situation where you have countries that are trying to industrialize and they're really just not able to satisfy all their needs domestically, and it's actually helpful to get surplus production for the rest of the world. And if they don't, if that's not what's happening, and that does happen certainly from time to time, it's much less frequent in the sort of the past 20, 30 years, then you lead to the situations we have where it's basically wasteful debt and bad investments.
So let me use this as an opportunity to also just contextualize what we're talking about in terms of sort of private sector deficits and sort of where it's the unsustainability. I think it's helpful, and hopefully this is not too complex in terms of what I'm showing here. So I've kind of plotted just sort of the balances of it, the current account balance as a percentage of GDP, the federal government's budget balance as a percentage of GDP, and then the residual of that is really private sector plus state and local governments. And I think it's just helpful to say we had a phase of very persistent private sector deficits starting around the time of the Asian financial crisis or so, all the way through to the global financial crisis, in which we had very persistent private sector leverage buildup. And even if you think back to the sort of expansion of the expansion of the 1980s, even then we saw that as private sector balances sort of fell and fell closer to zero, we saw sort of the coiling that ultimately I think was a big part of the story for why we had this the early 1990s recession, which it also, even though that recession is seen as a very short recession on technical terms, was also a very prolonged one in terms of joblessness. So private sector balance sheets had to sort of recover from that, and we had this sort of extended period in which, when we've had private sector balance sheets in a particularly precarious position, it has been, if it's not been a predictor of recessions per se, it's been a predictor of much slower growth in the future. This recession is different in the sense that I think the balance sheet perspective, it looks a little bit cleaner, at least in terms of if you look at strictly at surpluses and deficits. But the broader point is that there has been it is the private sector that really dominates a lot of this, and not necessarily about government. If you look at the Tax Cuts and Jobs Act of 2017, much of that has really flowed straight to the U.S. private sector's hands, for better and worse, in the sense that it's probably not really boosted a lot of growth, but it also didn't really boost a lot of inflation or even put any pressure on the current account deficit per se. So it was largely saved within the corporate sector, something Matt has written about in his variance column as well, that I thought was quite good. From now, it's I think getting on 2 years from that column. But I think the other point is, yeah, that we've seen, if we talk about the sort of where the private sector deficits are located, we did see in the late 2000s the corporate sector being particularly stretched, and in the mid 2000s it was households primarily, but also, and so this is just like a current account for the household sector. It's really just looking at a current account estimate of the non-financial corporate sector. So there too, I think you see a similar story. I hope this kind of provides some context for what we're talking about here. Shri, I'm really eager to kind of hear how you've written a lot about this the private debt project, and I'm just kind of curious how you made sense of both Matt's thesis and sort of where you think there might be places that are things that might be missing or things that might be like that you found especially salient.
No, first of all, I have to congratulate Matt and Michael for writing a great book. I agree with most of it. I mean, there may be some technical small disagreements which are not relevant for this discussion. I think I just want to add one thing. A lot of the time, which Matt and Michael do discuss in their book too, a lot of the times, and which I bring up in my private debt project, and how it is related to the balance sheet stuff that you're talking about, the private balances stuff. A lot of the times, countries, what they try to do is try to adjust for their own balance sheet problems via the current account, right? That is mercantilism. And that is what gets into other countries into trouble, right? For instance, Germany, coming into 1999, 2000, Germany was a sick man of Europe. People don't remember this, right? Germany was a sick man of Europe back then. And Germany had what we from the Levy Forecasting Center call it like, contained depression type of thing, where you had large private sector debt and balance sheets overcapacity, which you had to work down, like US had in the early 90s, and then again in 2008, 9, which you had to work down, right? So what they did was, how did they try to work it out? What the way to work it out is to run large government deficits, the way we have done it, both after 2008, 2009, and the early 90s as well, right? But that's always politically, right now, it seems like that's not as politically unpalatable as it used to be. But if you go back and remember in the early 90s, some of you were not born then, but in the 90s, you had Ross Perot. He was saying all this government is bankrupt. He was a very popular third-party popular candidacy. And 2008, 2009 too, there was still a talk about Reinhardt and Rogoff wrote their whole thesis. So, that was the thing. So what did the Germans do? The Germans decided to essentially beggar thy neighbor, right? So they lowered their wages and they decided to export their way out of the problem. So when you are, from a balance sheet perspective, what's happening? From a flow of funds perspective, when you are exporting in your private and financial balances, you are now getting in cash inflow for which, so you're generating domestic positive cash flow without the government having to run the deficit. And so the private sector can now repair its balance sheet, okay, without the government running deficits, which means someone else is now running a deficit, which means their debt is going to go up somewhere along the world, somewhere in the world. And if you see, there is a very good correlation between, although it doesn't have to be, but there is actually a fairly tight correlation between current account imbalances and the buildup of domestic debt, which I show in my paper on private debt project. So that there is a strong correlation. What did you see? You saw in Spain, you saw in other countries in Europe, they built up their debt. Now, what happened when they got into the crisis? They started to do the same thing because learn from Germany, do the right thing, and they all rushed. Then Eurozone as a whole went into surplus, and who took the brunt? Lots of the emerging markets. So big buildup in debt in the emerging markets happened in 2009, 10 onwards, 10 to 12, 13, and which all of them are still paying a price. You can see whether it's India or Brazil. I mean, all of them are still paying a price. And I think, what this has led to is globalization and free trade are all good. And up until 85, it was not generally associated with current account surpluses per se. What it was associated with, in fact, Korea used to run current account deficits until 1985. Mostly it used to run very large deficits until 1985. So what it has become is a tool for solving domestic imbalances, which means you're essentially putting the burden on somebody else. And this kind of problem is what leads to breakdown of the trade. The source of the problem itself is not probably globalization. It is, as Matt and Michael say domestic imbalances, domestic inequality, and which goes back probably to the 80s and the late 70s. And I think Volcker played a huge role in that. And that's where all this started, in my view. And you can blame this nebulous word called neoliberalization, whatever that word is, but I think it is a whole framework of policy mix that generally has meant perma-slack around the world.
Yeah, I think the sort of perma-slack term sort of fits a lot of the just how fleeting a lot of the what we call full employment, which even then I'm pretty skeptical. It's not as if high employment necessarily means either inflation, capacity constraints, or rather a low unemployment rate does not necessarily set that stuff off, right? We had a 3.5% unemployment rate last year. While the economy was moving solidly, it was not as if we were seeing an investment expansion of the world you've never seen. I mean, it's just, nor did we see inflation either, right? So the idea that just because we get, and these sorts of moments when we actually get that are very few and far between. So there's this asymmetry that is largely because we have tried to pursue full employment through a primarily private sector balance sheet, specifically U.S. private sector balance sheet perspective, right? So that while other economies rely on the U.S. As a source of consumption, the U.S. itself has chosen a policy mix that makes that very hard to achieve, both for the U.S. and the world as a whole, right? So I think there is some part of the story that I think is also about U.S. not really exercising its full agency to achieve full employment, right? Which is the part that I think in terms of, I know that the Trade Wars or Class Wars, the book, it's largely focused on where China, where Germany could be doing better, right? And it seems like there is a story where it's very easy to put, especially Germany is the one where it's like they are responsible. They're the ones who knew how to balance their budgets and get competitive, and that's what everyone else needs to do, except we all can't run trade surpluses together, right? And I think that's the part of the story that's right. But it's also the case that the US could be doing more to kind of fill in that gap. It's just that they've chosen precisely sort of the wrong primary tool of macro policy for demand generation, right? Which is we kind of just keep hoping that we can push on the string or just try to get to the point where we get the private sector to start borrowing aggressively. It can lead to some good things. It could also lead to some very disastrous consequences if it is sort of wholly supported by that mechanism. I think that's the part that is, and if you're left with with just that kind of model, we're left with expansions that maybe even long. We've had long expansions. We haven't really had strong expansions. We had jobless recoveries in the early 90s, jobless recovery in the early 2000s, jobless recovery in the early 2010s. I think part of that story, if you actually go back and say part of that is that it was especially weak in tradable employment. So the quality of jobs that were leaving was at least middle wage, especially in sort of that 2002, 2003 period. So you had a big manufacturing hollowing out that is also kind of tied to this other overall story, in which the U.S. is relying on private sector credit creation to drive this, while other countries are relying on some variant on mercantilism. I don't know.
Yeah. So that I tackled part of this in the other paper I wrote for Private Debt Project on inflation targeting regime that has been there. See, the part of the problem is if you look at it since 1979, so nearly 70% of the time unemployment rate has been above NAIRU. And that's assuming that NAIRU is actually a reasonable estimate of full employment. It probably understates how low we can go, right? So rather overstates, whatever the word is.
We could be employing a lot more people than we do.
We could, yeah. And even by that very watered down, the soft bigotry of low expectations, we have been above NAIRU for 70% of the time, something like that, since 1979, if you count it. Right? Before that, we used to be below NAIRU more than 2/3 of the time. So we've been generally running slack. So what is the relationship between slack and inequality? when you run an economy on slack, the people who are most vulnerable with the least skills are most likely to be unemployed, in and out of jobs, do not build the skills, do not build the career resume to be able to have stable incomes. And naturally, you have greater inequality, among other things. That's one of the things that causes it. The second thing that causes inequality to be high is when you have this kind of perma-slack, investment is weak, right? And when investment is weak, which has been the case since 1980, and again, Volcker has a big share of it because real interest rates were high throughout the 1980s. So if you look at the overall investment in the last 40 years, except for the tech boom and the housing boom, investment has been super weak, private sector investment, right? So private sector investment is the engine of private sector growth. I mean, you can say other things, but it is fundamentally the engine of private sector growth, but it's also the engine of improvement in living standards, improvement in jobs, improvement in quality of jobs, right? And that's been weak. And so those are the two main reasons why we have had inequality increase. In fact, I should have made the chart. If you look at real capital stock per worker, okay, and change in that, like 5 or 10 years, change in that versus the Gini ratio, that is a beautiful match. That tells you how closely, how this perma-slack regime, from just the pure US perspective. So if we want to take what your point is, which is we relied on, what do we rely on? We not only rely on private sector demand, but in a peculiar way, we rely on monetary policy to be actually spurring that private sector demand. And how does that work? It works by dropping interest rates. Dropping interest rates, it works by essentially making the private sector leverage up more, correct? And it essentially leads to a situation where balance sheets become unsustainable and you get into balance sheet problems, whether it was early 90s, 2008, and that's a recurring problem. So we get into this bubble and burst kind of recurring problem. In fact, even mainstream papers now have the same issue with a couple of papers. Atif Mia, Amir Sufi, and Straub have written two papers. One is Indebted Demand, and another one is, I forget the name of it.
Saving Low to the Rich.
Yeah. So this is basically addresses this point. What has happened with income inequality and what it leads to indebted demand.
Yeah, I just want to emphasize that, what Skanda was saying is, we've chosen to be monetary policy first. And, as Sri is saying, if you choose to be monetary policy first, then what essentially, in theory, there's more than one option. The other option, which, occasionally if you read Treasury transcripts, they'll talk about this, is that you'd have a weaker dollar and actually would lead to a switch in the trade balance. But predominantly what happens is it just encourages the private sector to borrow and spend more and consume more out of current income. And that obviously has limits to that, the sustainability of that process. And in theory, I mean, the really interesting thing is you look at the 2000s is when, at the time when the Fed was responding to the collapse of the tech bust, they thought that the dollar would weaken. And to be fair, it did on certain measures, sort of with a lag, but not by enough to really move the needle of, they might have reasonably thought that, okay, if the trade balance or current account balance went from essentially like a deficit of about 1.5% of GDP in the mid 90s to, 4.5% by 2000, that maybe you'd have some kind of reversal of that. That was when the U.S. was outperforming the rest of the world in terms of growth and the Asian crisis and crises in, Turkey and Russia and so forth. So maybe in the 2000s when EMs are doing well and the U.S. is doing poorly, you'd have some sort of reversal, which essentially you could argue that's kind of what Germany did. But it didn't work out that way. In fact, the current account deficit actually increase. And the sort of offsetting factor was you had this massive housing debt bubble. And what's interesting is that people at the time sort of anticipated this would be an outcome. I mean, there's that famous Paul Krugman column citing Paul McCulley, where he says, well, I guess we're gonna have a housing bubble because you're not gonna have a trade balance moving. The federal budget deficit, for whatever reason, is not going to move enough. Business investment, like they've switched to retrenchment mode. I mean, you look at, people talk about corporate debt being a big thing in the past 10 years, but in the early 2000s, corporate debt was basically flat, if not falling slightly, the outstanding in the US, which is a very different world from now, obviously. But back then, that was a real phenomenon because you have all these companies, Enron and WorldCom, they all go bankrupt, and suddenly you have a very different financing environment. And so it had to be households to take on the difference, but that was not a sustainable outcome, obviously. And, could it have been different? I mean, it could have, if people in the rest of the world had behaved in a different way, or, if the US policy had been very different. But of course, there's, for I think ideological reasons and just sort of part, not just ideology, but I think just sort of intellectual errors is the idea that monetary policy has to be the driver and fiscal policy is not. that really limits your options on what you can do. And that, and then of course you have these sort of sectoral elements where if you lose a lot of manufacturing jobs in one go, even if you're going to have strong growth in, construction and healthcare and so forth, which is what happened, the time it takes to actually do that and to move people around is naturally going to lead to slower recoveries. I mean, part of the reason why you have slower recoveries, since the 80s is because you have these, sectoral shifts. I mean, before you look at sort of the business cycles of the 60s and 70s, rightly or wrongly, essentially what happened was you had situations where companies would just, manufacturing companies would essentially produce more than the demand was needed. Then they were stuck with inventories they couldn't sell. Then they just, put people on furlough for temporarily. They sold the inventories and then demand returned and they hired the people back. And so that naturally led to very sort of quick business cycles up and down. And once you break that model, you either, you could, the positive way of describing it is we've had to switch to services, or there are other ways of describing it, but essentially like you're going to be having much more challenging environments that either require probably more activist government to get people employed, or you're stuck with the scenario that we've actually had.
Yeah, I mean, the 70s, for everyone talking about it as stagflation, I would recommend just while the unemployment rate remained elevated in the 70s, I think people have a sort of misconceived notion of just how strong real growth was over that period. Now, with oil shocks, obviously, kind of took away much of the sort of, if you look at it from an inflation perspective, it's sort of eating into real growth, and it probably also had its part to play. But like actual like housing starts and how like the amount of homes we built over that period. Again, this is also partly because of demographics, but the 70s itself, while not desirable in a lot of ways, some of the outcomes, I think the conception of it as this sort of combination of super stagnant growth has generally been going down since the 70s. It's not the case of 70s where this period of weak growth and then we saw much stronger outcomes in the Great Moderation. That's quite the opposite. I think the Great Moderation itself gets hyped up for all these reasons, but I think there's something about what Sri was saying and what you were saying regarding we had weak investment over. I think that is in some ways both the reason for why we've had sort of slower nominal income growth and inflation as a sort of byproduct of that. We've also seen that like this is something that could, as you said, with the fiscal policy, like if we did not take the monetary policy first proposition, if we took that as these are levers that are to be used in both complementary terms and terms that where monetary policy probably can't get you the direct demand you need, whereas there are decisions Congress and the White House can make that can actually make investment happen, right? There is ways to make that. And it's even whether that is directly through, sometimes we did this in the past through the Department of Defense. Sometimes we did this through public works. Sometimes we do this through state and local governments. There is a past, I mean, you went in your book kind of nicely highlighted from like Alexander Hamilton is just like, there was like industrial policy itself from a previous period where you can imagine a scenario where the US is not so powerless to deal with some of these effects, that investment itself, it is not as if the US lacked the policy space. It seems like the US lacked, primarily speaking, the like sort of political imagination around this that actually could have made investment outcomes stronger and as a byproduct of better employment outcomes, and may not have relied so heavily on the kind of indebted demand that sort of really characterized probably the worst parts of called the Great Moderation from 1980 to 2008, 9. So yeah, that was just a thought there that I feel like I'm kind of curious, especially with Mac. It's like I do think that's a part of your book that it's like I'm curious where that fits into the thesis, because that's sort of like the sleeping giant to me is sort of like, yes, I think it would be. There's clearly some part of it is about like these economies could be doing their part to just like they're running these huge, or they were running huge trade surpluses, or they are running huge trade surpluses. They could be importing more, demanding more, enjoying a higher standard of living. That's probably pretty important for those who are especially at the bottom of the income spectrum in those economies. But I guess that's the thing that's like, why, like, where does that fit into your thesis? I'm kind of curious.
So I guess a couple things. One is that I think we can reasonably make the case that even though investment has slowed down, that's definitely true, and you can really see sort of a serious break from the 70s onwards, with the exception of sort of the second half of the 1990s. The thing that's sort of the challenging question is how much of that is due to not enough incentives for invest, the government should be investing more, versus sort of this underlying problem, which is that the perception that businesses have that the return on investment is not going to be good because of everything else going on in the world. And, you know, I mean, I know Shree's made this point before, and I think we talked about this a little bit in the book, but essentially, if you're a company, why would you invest if you're not expecting your sales growth to be robust? That doesn't make sense why you would. I mean, maybe you're trying to do some sort of labor saving thing, and maybe, but even then, that's presuming that labor markets are very tight, that you'd want to be, incentivized to do that. So, the sort of the underlying driver of investment has to be consumer spending, whether it's in the US or somewhere else in the rest of the world. And, I think one of the arguments that one could make is that the reason why there's weakness in investment, not just in the US, but in many other places, is that there hasn't been enough consumer spending. And in fact, to the extent that there's been sort of reasonable investment outcomes in other places, but not enough consumer spending in those places to justify that investment, it's forced the US to have more consumer spending than otherwise maybe would have been appropriate. Although I personally am not of the view that consumer spending in the US is excessive. I think there are a lot of ways to show that it's not excessive. And we discuss that a little bit in the book. You could, even if you believe that, the argument is that there's essentially too much investment in other places that sort of wasn't matched with consumption in those places. So, for example, global investment to GDP has basically been flat for the past 40 years. There was no decline or slowdown. That's largely because of China, which had a massive increase in its share of global GDP and a massive increase in its investment share of its GDP. And that's offsetting developments elsewhere. And so the question is, okay, so they're doing a lot of investment, but that investment is not being geared predominantly for satisfying the needs of Chinese consumers. There's been some change in that direction, but like mostly that's not what's happening. And so that's an element of what's leading to these imbalances. And so, for the question of, I mean, another way of looking at this is that U.S. demand for manufactured goods, whether it's business investment in equipment or consumer durables, that kind of sort of higher end manufactured goods, it's grown at not, I mean, the past 10 years have been kind of weak, but like in general, the growth rate of that has been pretty robust, but production of those goods has been exceptionally weak for a very, very long time. And the series break is basically around 2000. And so what that suggests to me is that, basically US manufacturers just bore the brunt of this overall global mismatch. It sort of leads to a lot of, I think, understandable sort of political implications and consequences that we've seen over the past sort of 5 years. But, it didn't have to be that way. I mean, there could have been either, the production in the US would have been more production in the US would have satisfied more of the US demand, or there would have been more demand globally, but that's sort of an extreme mismatch. You don't really see that kind of mismatch in that direction in other places. I mean, you see some other places where you have much more production than there's consumption, but that kind of extreme mismatch between, basically flat to no increase in production over 20-year stretch versus very large increases in actual demand is pretty extreme. I think that probably explains a lot of problems.
Yeah, I mean,
Go ahead, Sri. Sorry.
I mean, going back to, you made a good point about the 70s. I mean, if you look at the genesis of this thing, right? I mean, I think the whole 1970s was completely misdiagnosed in the sense of, oh, we lost control of inflation, this and that, Really, if you really think about it, there was never really a complete loss of control. Inflation was high. Yes, sure, it was high, but we also created a lot of jobs in the 1970s. And if you go and look at what Burns wrote, you can see that he knew that the cost of trying to control inflation was going to be a ton of jobs lost, which is how we controlled it. There's no immaculate control of inflation through expectation fairy that, oh, we got down from 10 to 2, nothing happened. No, what we did was we decimated the manufacturing sector. That's what we did, essentially in the 80s, right? No, I agree with Matt that it's mostly since 2000, but a lot of the damage was done in the 80s. A lot of the damage was done in the 80s. And I have different ways of showing it. That a lot of the, and see, what was most of the time when we think of inflation as a monetary phenomenon, in a sense, it is right in the sense that if the monetary authorities are not accommodating the underlying inflation, real inflationary pressures, you will not have inflation, sure, but it won't be a gentle process of managed inflation. It will be completely chaotic, because if you go back and look at it all the way from the 60s to 82, what was happening was we were having these periodic efforts, like 66. What happened? There was a credit crisis. So then they said, oh, no, we can't afford a credit crisis, right? Because it's like 2008, the same thing, where you took the other side, the Hawks one out, and you could say in hindsight. And in 66, the doves went out. So then inflation went out of control. Then what did we do? We had the wage and price controls, and things seemed to be coming under control. Then again, we let it out of the bag in some way. But the real issue is you could not have controlled the process without creating massive unemployment. That is a real fact. Unless you have some kind of real coordination at the macro national level between workers, between employees, some broad incomes policy kind of thing, which we do not have, which we will never have probably. And, see, here is the thing. What is inflation showing? When you run an economy really hot, it's not, you can't really shift resources, whether it is capital or workers from one sector to the other seamlessly, right? So at any given point in time, when you're closing in on full employment, whatever that is, imaginary, let's say, there will be many sectors which are already at or above full employment and need to rapidly invest to grow, right? To meet demand, their growing demand. Now, if they have to do it, even as other sectors are also nearing full employment, there's not much slack around, you need to be able to redeploy this, but that takes time, right? So in the meantime, what you have is a relative price shift, which shows up as aggregate inflation because of stickiness. One sector goes up, others stay stable. You will start to see prices go up. You need to be able to invest and shift the resources there. That's what you need to do. You have to accommodate that process. You need to have some inflation during that time. That's my answer to that question. And it would have died out. In fact, inflation, in my view, was dying out before Volcker started doing his thing. So the real issue is we had those two oil shocks on top of that. That's really what complicated those processes. Plus, we had cola and all those inflationary processes which Vin Glodley has written about, and that's what really unhinged the process. So to come back to the point, I mean, when we use monetary policy as a sledgehammer to try and get everything right, you end up with this world where we are at zero interest rates and we are talking about all kinds of things that monetary policy cannot do, which is try and get inflation up. And we are now, and then we have to run these large deficits because there's no choice. There is not fundamental private sector demand without leveraging up. So you have to run these large deficits. There is really no choice on that. But the running large deficits comes to it's a political issue, which really you have to be able to argue and be able to make the argument in the political domain, which is what is a challenge in front of us. Really, that's what really is a challenge in front of us.
Yeah, I mean, the part about like the 70s, right? Which if you look at what sort of while unemployment did a lot of different things over the 70s in terms of going up and going down, I mean, the real trend in terms of like what guides both price increases and like sort of what ultimately led to interest rates rising too, and sort of in reaction to prices, was like you also had incomes growing at a pretty accelerating throughout that decade, right? So when we talk about like how monetary policy works, to my mind, there's a pretty big, it's how do you constrain incomes, right? How do you constrain incomes within the economy and can we do it more equitably, right? I think that's the other part of this. The US has had a very warped political economy. You can say, I know you're kind of like more dismissive of sort of neoliberalism itself. Obviously, it can be kind of applied a little too liberally, but nevertheless, like there is sort of how these costs, or rather how nominal incomes itself are constrained. You can think about sort of the decline in union density as being part of that. Union density is going down. A big part of that is just the deindustrialization of the US as well, right? So that's like where unions were particularly prominent, and through a combination of manufacturing going abroad, and then you have right to work laws, you have a lot of different things that are sort of working against organized labor over the subsequent decades. So that kind of reallocates income to those who are less likely to consume, less likely to create new income in the economy through new spending, right? Those are the sort of things that I think are to kind of get lost in the story about how monetary policy can be disinflationary, right? Like what's the ways in which this is enforced? And it's really hard to do it in a really fine-tuned manner, despite what the Fed is largely trying to signal they can do. I think there's a way that some of the stuff the Fed suggested regarding average inflation targeting, maybe it can be good if they're willing to sort of tolerate some higher inflation in the short term to ensure slack gets absorbed faster. But that I think is to the point that I think I wanted to get to something Matt was saying about the 2000s structural break. If you go back and you see what people were saying about what China is, rather what PNTR in 2001 was going to mean, and how it was sold at the time versus what people say are the best qualities of China's introduction into the global trading system, rather introduction, but rather to give them PNTR status, what that was ultimately going to mean, like there are two very different things, right? Initially it is, well, we're gonna have all these great export markets that will offset whatever potential jobs are lost, right? So booms replace busts and we move on, right? That's like that's the adjustment mechanism people think of. But for booms to happen in the US, for new exporting booms, for new factories to come up that are able to export to these new global markets that are all this potential, this is exactly the same way also that NAFTA was sold to the public in large degree. It was that there would be all this demand generation from demand abroad for US products that would sort of balance itself out, right? And I think that's a big part of, I think, what I like about Matt's book with Michael Pettis, was just that this is it doesn't really balance itself out, that there's necessarily going to be this offsetting demand generation. The persistence of this phenomenon itself suggests like it kind of sold a bad story about who creates like the demand naturally just sort of appears and sort of and it sort of helps to make the adjustment mechanisms. And now you have a lot of people saying, well, maybe it's because you can't buy a house in another city, and that's why there's all this regional inequality. People can't move to where the booms are. That's really why the China shock was so bad. I think this is a little bit of like, we can kind of just look to how this was sold to begin with. Nowadays, you hear, well, your goods are cheaper because of China. You should thank China because of it. And I'm kind of skeptical when the story just kind of changes to fit a certain policy view without ever acknowledging that the sort of talking points on the story changed.
So there is a great paper that the New York Fed economists put out, I think in 2017, that we mentioned in our book, which basically they took the David Autor, database of which particular zip codes and counties were most affected by Chinese import competition and, consequent deindustrialization, and then mapped it on essentially to sort of the Mian Sufi database of where consumer credit growth was the most extreme, particularly among sort of lower credit scores. In terms of, there's actually a very good match. And, I think that sort of tells the story right there in terms of what actually was the main consequence here. And really any of the other explanations is just not really, I don't think macroeconomically consistent. People just move to where the booms are. The booms would have been bigger. I mean, is that really? I mean, I'm not saying that we can't necessarily have more mobility and home building in certain metros, but like that does sort of it misses the broader point that like the demand that people expected to come from China and these other economies simply didn't show up, which was not, I don't think, to be fair, at the fault of anyone in the U.S. per se, but mostly. But that is something that basically undermines the justifications for an open trading system. If the basic justification is that it doesn't cause macro problems, it might cause micro problems, about like where the jobs are, what companies, but it shouldn't cause these kind of macro problems. But if if you have these other issues, then like it will. And that's really, I think, the challenge that people I don't think they've really internalized it yet for the most part. And I think that's something that hopefully we will, people recognize now and will hopefully come with better explanations and understanding of it.
Part of the problem really arises from the part of globalization, which is a catch-all term, is the more with the investment part of it than with the trade part of it. Because we did run a progressively easing trading regime from 1945 to 1973, and you could see the benefits of it, right? The developing economies grew, not on the basis of mercantilist policies running more and more current account surpluses. Export-led and current account-led is two different things. There was an export-led growth, but they were all running current account deficits until the 70s. So that was which is a classic textbook thing, right? You're a growing economy, you run current account deficits. So things worked very well. And there was balanced trade around the world. The US too ran a balanced trade up to the 70s because there were a lot of protections for US trading regime all the way up to the 80s. But once you went into 1990, people started to push for two things simultaneously, not just free trade, but free capital account. That was, in my opinion, the real danger. What happened was the free capital account created the financial instability in these countries, starting with the Asian crisis, of course, I mean, the Mexican crisis, the Asian crisis, all the rolling crises. But even before that, in the 1980s, all the Latin American countries had their problems.
Yeah, start there.
Which then creates, what does it do? It now creates precautionary demand, right? There is no FDIC for the global economy, which is IMF, which did a terrible job in '98. So then what happens? You have precautionary demand. Now then what do you do? How do you do precautionary saving? You now dampen demand in your country, structurally start to dampen demand, which is why 1998 is such a seminal event in that sense, which I think Matt's book also brings out, that the opening of the current account. In fact, it's a very interesting thing. If you look at, I think it is Article 6 of the IMF, which relates to current account and capital account. IMF actually wanted to amend that so that to argue for free capital accounts. The original IMF charter was for only coming to rescue for current account problems, not to deal with debt and capital account problems, to deal with current account imbalances, and they would help them restore it, right? That was what the whole idea was. But if you look at the crises in 1998, it was largely caused by capital accounts in some sense, hot money flows and things like that, right? So it was not the classic old, in the old Bretton Woods era where people would get into reserve problems. It was because they were importing more than they were exporting, those kind of issues, but not relating to capital outflows. So IMF was actually, now IMF is clearly, at least one thing they have learned from that, they have backtracked from that, but they were actually arguing forcefully for, and the original WTO argument was also for that, that we need to open up the capital accounts, so one of they were increasingly part of the WTO's mandate was open up the capital accounts, right? And I think that is largely the reason why you have had the need to, which started with the accumulating reserves, which means you're starting to dampen your economies now, and start running current account surpluses, or you're keeping it damp enough so that you can attract inflows and keep building up the reserves. That's a big part of why your point about why the trade benefits of trade didn't work out. Okay, we lose some sectors, but we'll come out of it because others are keeping their demand permanently depressed or forced to keep it by forces.
First of all, I just completely agree with that narrative and interpretation. It's basically, the story we try to tell as well, that, especially if you look at the case of China, I think is most extreme, is they see what happens in Indonesia with Suharto, who'd been dictator for, 30 plus years and then is completely undone after, because of this crisis. They think, why on earth would we ever put ourselves in that kind of situation? And that is at a time when people within the Chinese leadership were thinking that liberalization of financial flows would be a good idea because it was sort of fit with what they were doing. The other thing I want to point out, though, which is also kind of ironic given, subsequent experience, is that the push for open capital flows or financial accounts from the WTO and the IMF was led by the US Treasury and was informed by the desires of the American financial sector. So, this was really a situation where sort of two elements of the US economy were essentially at war with each other in a way that played out in the rest of the world. And it happened to be one side did very, very well, another side did very badly. And looking at it sort of country by country sort of misses that dynamic, I think, which is that basically American, so oversimplified, but like American investment banks and asset managers won and American manufacturers lost pretty decisively as a consequence of, whose priorities were in power at the time.
There's a congressional hearing, I believe, with Kamala Harris's father, Donald Harris, in which he specifically talked. I think a lot of this really starts with the LATAM debt crisis in terms of these sort of political economy dynamics in which call it the U.S. financial sector interests also kind of pushed for certain types of macroeconomic policies and the sort of prioritization of being paid and sort of the havoc that wreaked on a lot of Latin American economies in the early 80s. There's a really fantastic discussion. I'll try to post it on my Twitter timeline, which is it kind of keeps sort of occurring again in terms of the need to sort of globalize finance in ways that the system itself isn't really equipped to handle properly, right? Like when we think about even with sort of the failure of Lehman Brothers and what actually was made it so complicated and what makes too big to fail a thing. A lot of this has to do with sort of where all these banks are structured across borders, and we have no sense of how to unwind these institutions that exist across jurisdictions. How do we resolve them? and it kind of leads to a lot more complexity that then I think in one sense there is clearly a certain selfish interest you can point to. It also seems though that like there is also some level of lack of consciousness about what kind of choices were made. This kind of goes also back to like Matt's earlier points. Like, was this the choice that U.S. lawmakers and policymakers were trying to make when they sort of liberalized trade, especially with say China in 2000, or even NAFTA? You can go back to sort of what were the actual choices being made, and were people actually satisfied with what ultimately transpired? I think there should be a really I question that this is actually what we bargained for. I think it's also the case of it does sort of suggest. I'm not sure though that it's hard to say we should leave lawmakers and policymakers off the hook though either, in terms of how much more thought could be given to what like a sort of more balanced global trading regime looks like. What sort of, if we're going to do sort of globalized finance, it probably starts to ask the question of how should swap lines actually be allocated across DMs and EMs, at least those for which we're trying to develop deeper trade, investment, and maybe financial ties with. I think that's the part of it, is like the U.S. like just because the U.S. policymakers and lawmakers didn't think about it. I think this is something with Matt's book. I'm a little bit. The uncomfortable part about it for me is like, why is it not the case that they should be thinking, like, shouldn't they be thinking harder about these questions too? Like they could have thought about it ex ante and ex post. I mean, Robert Lighthizer has it's a really funny testimony to read. I think it's in 2010, where he kind of points out all of the ways in which China trade was sold to the American people, PNTR, and how it's like just not played out the way that it was predicted to. Like, I don't know, there were people talking about it. It's just that they tended to be politically powerless, I guess, in the moment. So I'm just kind of curious, Matt, what role should that play? Like the lack of consciousness about these sorts of decisions and trade-offs seems like.
Yeah, I mean, the part of the issue, I think, is just the profession or whatever, if you want, like the expert class that is supposed to inform what policymakers, then can choose from many of options, I think also just failed. So I don't think it's really fair to blame people who don't specialize in this stuff for not, getting all the nuances, when the people who do specialize it ostensibly were also giving bad advice and not really understanding a lot of the issues. So I think that should be the first priority. And then, hopefully, think people can make a better set of decisions from there. One thing that's interesting, we talk about the LATAM crisis. I think 1998 is in some ways the biggest point, because that's really when it affected China, and China was just so large. But I think it's also right to say that what happened in LATAM, and incidentally also happened, less well known, but in basically the communist bloc in the same period.
Yeah, that's right.
That also had a significant impact, both in two ways. One is if you have a situation where all these people or enterprises or whatever were buying things, including from the U.S., and then have to force to switch to debt repayment. Again, that's a situation where the people who are owning the assets and getting repaid are benefiting at the expense of people who would have been selling them more stuff. And so again, it's not really a situation it's Americans taking advantage of the global South. It's really some Americans taking advantage of other Americans, and it happens to be other people somewhere else who's sort of the vehicle for that. The other thing that's interesting is that in general, most countries did not respond to the Latin American experience by changing their sort of financial macro-prudential policies the way we saw after 98, with one notable exception, which is Taiwan. I think that sort of relates to your political economy point, but is that, so if you look at when did Taiwanese central bank reserves start growing, it's basically right in 1981, 82. And that's when it starts growing up like a rocket throughout the 1980s, well before everyone else basically went into that. And I think that's very, instructive for what the implications are, because who knows, maybe that will change, but I'd be very surprised if the Fed would open a swap line with the Central Bank of the Republic of China anytime soon, because that would be sort of fraught with all sorts of geopolitical, who knows, maybe that will change, but that, if you are taking the view that you are the government of essentially a pariah state, then you sort of have to be behaving in a particular way. And you can also see why, Russia, for example, when oil prices started falling in 2014, 2015, some people thought Russia might sell down some of their reserves to cushion the blow, which is what a lot of other oil exporters did, including Saudi Arabia and Nigeria and stuff. And the Russians did not do that. They just completely it all passed through to the exchange rate and all passed through to lower consumption, just brutal import compression. And the reason is probably that they had an experience of what it was like before, when they had to rely too much on foreign debt from the West, and that led to the break of the USSR. So and the loss of, even before that, the loss of control over the Warsaw Pact. So I think those kinds of things are much tougher to deal with in terms of precautionary savings. I mean, I think I would hope that, permanent extension of swap lines to South Korea, for example, would hopefully obviate some of the need for the precautionary saving you see there. But like, I don't think that's in and of itself going to be sufficient for dealing with these other global issues, unfortunately.
Yeah, I mean, to answer your question, Skanda, were people talking about it? Certainly, I mean, it is not just people in the heterodox, who were completely, of course, submerged, whose voices, but even somebody like Bhagwati, who in the 1990s was a pretty, he was a front runner for the Nobel, pretty ardent supporter of free trade. He wrote in 98 a book, I think it was Free Trade but Not Free Capital Flow. I mean, I don't remember the exact title or the exact, he wrote articles, he wrote books, he was clearly articulated the point that free capital flows is not what we have signed up for. It's not the same as free trade. And, see, finance is a very tricky thing. And when you let it loose, the consequences to answer your question about did policymakers know, should they have known? No, I don't think one should see that they visualize this whole thing and they should be, or we should hold them accountable for not visualizing it. But what is the salutary lesson of the last 30 years is finance is a dangerous, powerful, but also and potentially destabilizing weapon, right? So we have to be careful when we are talking about liberalizing finance, whether it's across borders, within borders, how to do it. You do it in piecemeal steps and then see whether it works out, not works out, with what it, you don't do it in whole big bang and keep relentlessly pushing in one direction. And I think that's really the problem, is not insofar as, okay, let's roll back the clock, let's go back, let's roll back all capital flows, let's roll back, that's not going to happen, let's roll back all the Glass-Steagall and all that. No, that's not the point. The point, you do it in piecemeal way and try to see how it's working and see whether it is robust. If you do not, you take an empirical approach to it rather than a theory-laden approach that, okay, my theory is telling me that free capital flows are great, and we should do it, and all these others are outdated theories. And then what happens after 20 years, you can come up with 10 more papers now, say, that was all wrong, this is right. But, I think it's not very helpful now to write all these things. I mean, it's good to write papers. I'm not saying one should not be writing these papers, but at the given point in time, it should really be driven by caution and empiricism rather than by theory. I think that's one lesson for policymakers in general speaking, and the history is littered with those kind of problems. But to answer a question about swap lines, which I have often discussed on Twitter. See, this comes back to the issue of who do you ultimately, you have to make it's a political decision, because if you are going to offer swap lines, it's an unlimited swap line in a crisis. Effectively, you are offering the full faith and the credit of the US government in some way, indirectly. And ultimately, that's where you make the call whether, okay, who is the coalition of willing, who you're going to trade with and who you're going to go to war with, right? Ultimately, that's what it is in this sense. It's not a real war, but, and that may be very tiny. Ultimately, if you figure that out, the people with you can coordinate policy, who would be willing to sit down and coordinate policy, that may not be a very large coalition, unfortunately.
No,
go ahead.
Sorry. Yeah.
Go ahead, Matt.
All right, I was just going to say, I mean, I sympathize with that perspective. I mean, that's basically the perspective that, Adam Tooze had in Crash. I think that's definitely how the people at the Fed and the Treasury are thinking about this. But I think the alternative perspective is the broadest possible safety net you provide is basically a way that, irrespective of who's doing it on the other side, is ultimately going to be good, through some mechanism for your exporters. Right. And so, you could say, oh, we might lose money, but you could just think of that as a way of, the extent that any FX intervention might lose money. You could think of it from that perspective, and so that might lead to different decisions than were made. But I definitely agree with you that that's the predominant view, is that, oh, this is like the circle of trust, and so you better all be on the same side. And unfortunately, that doesn't lead. I mean, that can lead you to large financial centers, so basically Europe, the UK, Switzerland, Japan, Korea, we had Brazil, the most recent round, but there was definitely stories a few years ago, like Turkey asked for a swap line in 2008 and they did not get it. I think Indonesia was one of the other ones. So it gets kind of fraught quickly, but
I know.
I mean, I agree with the sort of the point about the coalition of the like it does ultimately reflect like some deeper coalition, and I think one thing we've kind of just discovered with kind of each wave of globalization is just how much like institutional alignment you really need to be able to make these structures work in ways that feel at least equitable, right? I think just to kind of go back to the question, I'm not so much about the how much foresight did lawmakers have, how much foresight did policymakers have, but I even remember from the 2000s from like watching a lot of cable news as a teenager, like people would treat people like there's a certain like which interests are lawmakers and policymakers responsive to, right? I think that is something that it's not as if these questions were all had to be decided. Like, is the answer like technocratic reform itself? That's kind of what like Matt's saying. That sort of seems like maybe that's an optimistic solution. That's kind of like what that was sort of Keynes's vision of what like economics could be. That just like if we have better technocrats, if we have a better like appreciation for empiricism and theory and the practical, like we'll figure it out, and then that'll lead to better policy. I think what you see sort of in the 90s and 2000s also like there's a dismissiveness to those interest groups that are most clamoring for sort of some kind of like Lou Dobbs on like talking about outsourcing and like how we need to move to more protectionist policies is like labeled a crank, right? Like he's not the person who kind of moves things in terms of in terms of who voted for PNTR, it was both parties, right? Like there's just like a lack of responsiveness. Is that it's like one set of interests did kind of win out in terms of what they wanted. I think that's there is like a part of this where it's why it didn't have to be that the financial interests were the ones that the two-party system really catered to. If to the extent it was financial interests, I think it was also just that you had a lot of companies that saw sort of the labor cost arbitrage abroad and found that to be attractive. It's not like the U.S. Chamber of Commerce was against PNTR, right? So it's like we're talking about a much broader coalition of business elites that kind of sought this out. So the question is why, but there were clearly losers and from this whole process, and why the political system wasn't responsive enough, right? I think that's the thing is like, I don't think it has to be the case that they could have seen this whole thing coming to sort of still say that they could have also been more responsive to the needs of those who were most vulnerable to this type of shock and this type of like process that has not really worked out for a lot of communities and a lot of people who are not otherwise like the whole point of a democratic system and a political system is to actually give more of a pedestal to these people. That's obviously subject to some realism. You got to take into account, but it's not clear why did this fail so much. I don't say fail, but why did this end up being so pear-shaped? Like if you say from the optimism of 1999 2000, in which you had a high investment, pretty high employment economy. Like we kind of moved to also seeing the world through the lens of now, where it's like we've had some deep recessions, very weak investment, and the geopolitical landscape's also changed, not necessarily in ways that we could have that are particularly helpful. I don't know.
I mean, the U.S. political system, I don't think it is very responsive. Partly it is broken for a variety of reasons. And, my view, which is mostly borrowed from Huntington, is the US is an archaic political system not fit for the modern world. We
okay.
Proud of it. But you should go and read Huntington. It's not my original idea. Huntington. And US is a modern society with an archaic political system, which people confuse for a different thing. But if you look at it, because you see it very starkly, right? If you look at the manufacturing jobs as a percentage of overall jobs, in terms of being responsive to the populace that is affected, right? The US is by far the worst among the major economies, like compared to Japan, even Switzerland, right? You would not assume Switzerland has got a huge amount of manufacturing. It's got a lot of manufacturing for such a high cost economy. You don't realize how much manufacturing employment they have. Germany, of course, right? So, but even if you go down the line among the developed economies, just leaving aside the US is by far the worst in terms of how much we have lost. So in terms of not being responsive to the losers of globalization, right? Being accommodated to their interests. And this started again in the 80s itself, as I point out, but much worse in the 2000s, certainly accelerated in the 2000s, but certainly the 80s was a very bad decade. The 90s was not. So the answer is clearly the political system is not responsive. If you go back to the 50s and 60s, you can see a lot of things that used to be safeguards, right? So US, whenever the US companies used to invest abroad in joint ventures or their own thing, or they used to sell technology, one of the conditions they used to have, especially if they were funded by Exim Bank, was those facilities would not be used to export to the US. Leave it. I mean, I'm not recommending that we do that, but that was clearly driven by the need to protect US labor. All these policies were driven by need to protect US labor, right? That was whether that's the right policy or not is a separate issue. All I'm saying is it was a very different policy environment and very different political environment that clearly undergirded those policies. And I do not know why it is not there now. I'm not a political science expert, but clearly it is not responsive to large swathes of the population in some way or the other. And I hew to where Sam Huntington said it's a Tudor era remnant.
So just to push back on that a little bit, I mean, I not having read that particular Huntington piece, I'm not going to judge it one or the other, but I don't think that what happened in the U.S. is actually that unique. I do agree with you that the impact on manufacturing in the U.S. was disproportionate. And I think there are reasons for that. And we talk about some of them in the book, essentially, because we absorbed the excess production without, lifting our own demand, sort of that's how it's going to be, right? You basically just have displacement of your domestic output, which is what happened. But the flip side of this is that a lot of the other phenomena we're talking about, I mean, like if you look at German politics, which we talk about this in the book, like you basically see the same kind of choices being made, the same kinds of reasons, if anything, like less economically informed. And, they're very different political system than in the US. And yet they nevertheless came to the conclusion that, well, we're going to basically have as much outsourcing as possible. And if we want to prevent outsourcing, we're going to prevent outsourcing by basically slashing labor protections and getting rid of welfare. And that was and cutting corporate income tax and things like that. And that was basically their approach. And, the reason it led to a different result in the US and in Germany is mostly a function of sort of what happened with sort of household balance sheets to sort of offset that or not. But I don't think it's sort of uniquely a U.S. problem. I think this is much more of like a global issue. I mean, you can also look at China, right? It was a very different political system, obviously. But again, who are they being responsive to? Like clearly not Chinese consumers and households who make up the vast preponderance of the population. I mean, for a long time, quite frankly, the CCP was more responsive to the needs of foreign companies that had invested there. I mean, that sort of changed more recently, but I mean, there was a long period of time when that was effectively the case, where they basically, no environmental protections, no labor protections for Chinese to support the profits of multinationals operating in China. So, I mean, I don't think this is sort of a uniquely, I think this is a much more global problem of, why are governments not really representing what's in the best interest of the preponderance of the people who live there? I don't think unfortunately, I don't know what the solution is to that, but I mean, this is definitely more complex than, something specific to the US or for that matter, having, better technocrats.
But I mean, I guess that there is like a little bit of, I think to the extent like the thesis you're putting forth about these countries could consume more, could import more, they could just be paying up. Because Germany, they could pay higher wages and we would all be better off, right? It could support more US employment. I think that's right. I think there's something about introspection within China and Germany that's probably like, we could be doing better and we're not, right? I think there's like definitely, there is some dissonance though that the US has more inequality, right? Like the US is a more unequal place that the elites have not cared as much about protecting US employment to the same degree. Maybe there's been other priorities, whether it's like because there's just more of a flawed framework. I mean, ordoliberalism has its sort of macroeconomic framework problems. Same thing kind of goes for sort of what was the Great Moderation and sort of trying to do fiscal tightening and inflation targeting without really bothering to look at it as an investment. and employment. But I guess like there is something of a mismatch here where it's like there's more inequality in the US. And there's been more conscious policy choices made in Germany and China, I would say, at least, about these questions. And is the answer really just that US needs to kind of wake up on where are their degrees of freedom and how much to exercise them, right? So Extreme's point is maybe like an extreme example of like sort of the export-import bank, like taking pretty mercantilist approach to it, maybe not the best way to do it, but it is that there are a lot of levers here to sort of toggle with the global trading system. The US does have sort of, if you think about like what are the different dimensions of state power, like the Fed just does swap lines with whoever is like current needed to kind of stabilize the system, right? They don't really think too hard about sort of like we want to like decide this is the coalition of people who have them more so than it is this is the place where the financial centers are and are not too controversial, right? Like that seems to be the rough idea around like you have to kind of make sure that the European financial system is also stable and has dollar funding. But it's not necessarily one where the US is trying to make a very concerted effort to decide the objective is to protect US employment. That like never comes into the calculation. It is, this is kind of the system we have. We kind of have a very light touch approach to everything. So I think there's like a part of that there could be a lot of agency here, but it's just like missing, right? There's a lot of room for like the US agency in the story is like, yes, it's a lot of inaction that kind of leads to this, but it's not like as if that inaction is a destiny either.
I agree with that. I mean, I guess one thing about the Exim Bank, just to push on that point, I'm not sure how much that actually really did anything. I mean,
sure, yeah.
Just because, like in practice, right? Let's say those facilities didn't export to the U.S., they still would be essentially taking from exports that would have come from the U.S. to those countries, or alternatively, other countries, that still matter. Like the sort of the global balance. I don't think like people say like if you move manufacturing back to the U.S., you're going to change global balances. I don't think that is obviously true at all. I mean, we say this in the book. Like, there's nothing wrong with opening factories in China. The problem is that the people in those factories then didn't spend any money because they weren't able to, and like so that's what I would say on that point. But
no, I do agree with you, Matt, that it's not a US specific phenomenon alone. There is a global phenomenon, including in all the emerging markets, of rising inequality, right? Which is why we are in this shape with EMs too, is that after all this boom, what you have created is a situation where you don't have sustained final domestic demand created by home demand, right? Because you have not broadened your base. You have not broadened the demand base. It has been a very narrow demand base and very high inequality, especially in India. I mean, it's not just India, all the EMs, this is true across the board, right? It's a global phenomenon. I don't want to deny that. I think but there are some US peculiarities. I feel there is less responsiveness in the political system for a democracy than I come from India, and I can tell you there is far more responsiveness to the average needs of the average populace compared to here. There is certainly far more responsiveness for a very poor country with very little resources related to what the US has. So there is a big difference in that. No, so on the export-import point, it was not just the Exim Bank, but there were other things I don't recall exactly. It was not just they couldn't export to the US. There were restrictions on their using those facilities for exports overall. That is, they would be competing with the US. I don't recall the exact details. I was just doing the research for something that I was working on. I'll find it and I'll let you guys know. But so there was all those kind of restrictions, which is not to say that again, I don't want to endorse any particular policy. But the point is, what those policies tell you is that the policymakers are responsive to the needs, perceived needs of various segments of the population. I think that is the difference, is whether they are not responsive. And right now, the whole idea is like, okay, we should do some retraining. Okay, how much are we spending on retraining? How much are we doing on that? What exactly have we done on those retraining programs? Right, or relocation, which comes to Skanda's earlier, he alluded to, is there are lots of barriers to mobility. In fact, Yale law professor Schweiker has written about this stuff, but we don't do anything about those things. In my mind, and I have done some econometric work on this, the barriers to mobility are a significant factor in keeping perma-slack in the labor market, lowering productivity, lowering investment, and lowering growth. All of these things. It is a significant factor. Whether it is a dominant factor, I don't want to say that. I certainly don't want to say that. But we have all kinds of, I think where the benefits and social benefits that you get depends on where the location you live in. That's what I'm not sure about the legal aspects of all these things. Then there's occupational licensing, housing costs being so high that most people can't move. All those things are really causing the problems. At least we could have done those things domestically. Forget about the trade aspect of it. Can we do those things domestically? Why have we not done those things domestically?
Yeah, I mean, just to tack onto that, right? That's where you have, like I was kind of saying some of the short shrift to sort of labor mobility stuff, but it's like you have people you could employ, you could sort of fix those problems. And I think there's a sense of, well, we wanted to sort of liberalize first, but like, oh, oops, well, it would have worked if we just had more transfers, right? If we transferred from the winners to the losers, we'd all be better off and we could still do liberalization. Oh, if we had just like made labor mobility higher, which I don't think is the answer for why you would not have had more people take like a bigger boom because people would have been able to move places. It's probably the case that we seems like there's plenty of room to build more houses, and that's more capital formation, and that would probably be helpful. But it's like I think there's like all these areas where it's like only after the fact do we sort of start to think a little bit harder about these questions. When there are constituencies that are particularly worried about these sorts of effects, and I think not irrationally so. That like I said, like Ross Perot, as you brought up, was like, you got a lot of bad ideas about macroeconomics, but he also was particularly more sensitive to this. And like, so there's this fringe coalition of people, and everyone else kind of, in the end, didn't really care about like what he was saying about trade. Now, whether he was right for the right reasons or not, I probably there's some cold water there. But I think that's like, it kind of does show there has been a shift in responsiveness, and there's a big inequality story here. If you want to call it like these political economy dynamics inequality, or just like how power gets allocated and who actually does the system respond to, right? These are, a lot of these problems are things that the government could either get directly involved in or try in terms of how fiscal policy or actually having a state directed transfer program. And there's just like a lot of agency there that just like kind of gets, oh, maybe we'll give them some like retraining dollars that don't do a whole lot for the trade adjustment. Right, these are not like they could be doing a lot more in terms of, if you want income replacement, not just like a one-time transfer sort of setup. I guess that's a part of the story that I mean, obviously we're running. Like that was the part of it, like Matt's. These that I kind of struggle a little bit more with, even though I do agree. Like Germany could spend more. It seems like Chinese people could also be consuming more, and they'd have certainly the worst off would have higher standards of living. But there is like a certain dissonance there. I don't know. Let me give you the last word.
All right. Well, I mean, first of all, I mean, I agree that there are things that the U.S. can be doing more, and we do lay out, some of those things. I mean, the main potential issue is that they would likely lead to higher levels of government debt, which might be a worthwhile trade-off, probably is under current circumstances, but that is sort of the trade-off that, for example, if you're expecting that you're going to be having the same problems of global demand suppression in the rest of the world, U.S. demand increases because you make the U.S. a more equal society, boost consumer demand that way, reduce the saving glut of the rich that, Mian, Sufi, and Stroud pointed to. You'd expect that to show up in sort of in the aggregate in more production and also more consumption and investment, and that the increase in domestic demand probably would exceed the increase in production. So that would show up somewhere as, higher debt. Again, that's probably worth to doing, but like, that's sort of the trade-off. I think it's probably why it hasn't happened in part. Not this, again, I don't think it's the best reason. In terms of like what the solution is or a solution, I mean, one thing that we pointed out a couple of times is, it seems sort of simplistic, but probably the most effectively direct thing is if you think that like the U.S. manufacturing sector is at this sort of permanent disadvantage because of the structure of the global financial system and demand suppression in the rest of the world, you could just have the federal government borrow and buy U.S. made goods. I mean, there are obviously a lot of issues with that in terms of like how you structure the buying and, all sorts of, what are the right amounts and whatever. But like that would be, if your concern is having a manufacturing sector, then, and you think that there's sort of the systematic bias against it, and you also think that that bias is partly caused by sort of systematic foreign demand for your own assets, then sort of the straightforward trade-off is, create more of those assets and then prop up the demand. So, I mean, there are a bunch of ways you could theoretically do that. I mean, defense procurement is sort of a tried and true method, though obviously there are potentially issues of how you do that correctly, but like that's something that you could do, which I think would potentially help a lot, could have helped a lot and was not done, but still could be done. In fact, actually, you can see, I believe in Biden's campaign proposal, one of the things is they're talking about doing that. So that's potentially interesting to see how that would work.
Sri, would you like? Sorry, do you want to say something?
Yeah, I mean, barring some grand global coordinated policy, which I don't expect will happen ever, I think what can the US do unilaterally on its own is, I think we can certainly run. We are willy-nilly, we are doing it. We have to be running larger deficits. Can we get there in a sense of not willy-nilly, not by default, because we are in such bad problems, we have to keep running higher deficits, but in some proactive way, construct fiscal policy that actually also improves productivity, create more assets and things like that, whether through infrastructure or whatever, we should have that debate. I think that's the one thing that is doable reasonably. I mean, among all the political things that are doable, that's one of the probably doable things, is to do fiscal policy and say that, look, we are creating assets for the future generation. I mean, at least that is something that is within the realms of possibility. Are we going to get a grand global agreement on Germany and China all agreeing to stimulate their economy? And no, I don't think that's going to happen. I mean, there's no way that's going to happen in my mind. So in the interim, that's what we could do. That would at least allay any concerns about government debt. And at the same time, be reasonable that we are actually creating assets and which will improve productivity, which is actually true, that public investment is very correlated with productivity.
Yeah, I mean, I think I agree with that in terms of there's just to the extent that it's about fiscal policy and the fear of deficits, then it seems like then Stephanie Kelton's deficit myth book is if that's really just about fear itself, then that's actually in some ways probably a helpful antidote to some of the fear and hysteria that's been promoted, just because we need to think about the assets created from the debt that's actually being issued, and to some extent that's debt creates assets, deficits correspond to surpluses. We shouldn't be thinking about it in those terms is a big part of the story. I think that's right, which I think is they say there is a certain fear. I'm not sure whether it is better to accommodate that fear by sort of pointing the finger at not pointing the finger, but just saying that, these other countries that run fiscal surpluses could run, or current account surpluses could run lower current account surpluses. It's that is, I think, hopefully that happens. I think there's just a big part of this is using fiscal policy proactively is also just something that should happen. And it's especially if we want to move away from the sort of credit centric view of how business cycles should behave and how we achieve full employment, I think that's got to be a big part of this. The other thing is also the U.S. is a consumer of last resort. I think is the way I think about a lot of this stuff, where we run very persistent current account deficits. Other countries that have floating exchange rates, their biggest benefit to weaker exchange rates, which oftentimes curb their own import demand, is the prospect that they actually can a stronger dollar. It's probably less true now because of sort of the way the U.S. export mix has shifted, but that the idea that U.S. would consume more if the dollar was stronger, and that would sort of prop up export demand in foreign economies. Part of that means the U.S. also has to think hard about market access, right? The question of who do they try to develop trade and investment ties with, and how much alignment is there really for that? I don't think that's something that should be beyond sort of at least the exploration of what that actually means. If that means quotas, if that means some kind of sort of more, it's not quite to the delight of the trade liberal, I think that's okay. I don't think that's worth exploring. I thought it was a really good discussion. I know we've got 10 minutes over time. Really thank both of you for being so generous with your time. And I hope we can do this again soon. Hope the viewers found this fun too.
Thanks very much for having us.
Thank you.